Hi everyone and welcome to Swissquote's Daily Market Talk. Sovereign bonds staged a notable rebound yesterday as investors around the world bet that surging energy prices and the risk of energy scarcity will cool global growth enough to limit how far central banks can tighten their monetary policies. So yields pulled back across the board and stocks were better bid as a reaction. But headlines are too volatile and optimism remains quite fragile. So we will talk about all that in a minute. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So yesterday was marked by a notable shift in perception and a notable rebound in sovereign bonds on expectation that higher energy prices and possible energy scarcity due to the Middle East war will slow global economies enough to prevent central banks from raising interest rates though roughly. This was the thinking that explained the positive action that we saw in bond markets since yesterday. So a benchmark for European 10-year yield bounced lower after rising to the highest level since 2011. The British 10-year gilt yield returned below the 5% psychological mark, while the US 2-year yield that best captures the Federal Reserve's rate expectations retreated to 3.80% level, as the Fed chair Jerome Powell also said yesterday that longer-term US inflation expectations remain in check, and that despite the energy-led inflation wave that already hit the shore. By the time the effects of a tighter monetary policy take effect, the oil price shock is probably long gone and you are waiting on the economy at a time when it's not appropriate, he said. And Japanese 2-year yield auction saw strong demand today as well, and the Japanese yields are lower again this morning. So in summary, bond investors and big names, big institutional names considered that the yields have now risen enough to take into account the impact of rising oil prices on inflation and monetary policies, and that it was now time to price the next step. The next step of easing monetary policies, because energy prices and tighter monetary policies would hurt. And it's right, it's not all wrong. Slowing growth will be the likely consequence of this energy crisis and potentially tighter monetary policies to deal with the resulting inflation peak. But first, central banks, at least some of them in Europe, for example, will have to adjust their rates to fight inflation. The European Central Bank, for example, is not willing to wait too long before acting, and depending on the impact on growth, well, they may have to ease their monetary policy again, but later. So jumping directly to central banks will have to loosen their monetary policy because energy crisis will hurt, and lower yields is good news for equities is a bit far-fetched. Still, Stoxx 600 rebounded yesterday nearly 1% despite escalating tensions in the Middle East, while the FTSE 100 gained 1.61%. In the case of FTSE 100, the rally in energy and mining stocks did make sense indeed, but for the European companies on the main continent facing another energy crisis and higher interest rates from the European Central Bank, I found that yesterday's optimism was weakly supported for a sustainable rebound. And in fact, let's speak about facts. The early CPI figures for March confirmed that inflation in Germany jumped from 1.9% to 2.7% year-on-year in March. We are here talking about a 1.2% jump over the month of March. And there is no surprise, the main responsible for that is the rising oil prices due to the Middle East war. Then a separate survey from the European Commission suggested a notable jump in selling price expectations. It's also undoubtedly due to the soaring energy prices due to the Middle East war. And other Euro area nations will be releasing their own CPI updates for March in the coming hours and will probably confirm the same thing. Energy-led price pressures have risen during the month of March due to the Middle East crisis. And for those who still doubt, the ECB officials have been insisting very heavily that they will act to rein in inflation. They just don't know when they're going to raise rates, but they don't necessarily look past the short-term spike in oil prices like Powell does. And that means rate hikes could well be on the menu of the year for the euro area economies. So I just can't stop thinking that there could be more pain for global businesses and equities, pain from higher energy prices and tighter financial conditions before relief. Hence, in the United States, the falling yields yesterday couldn't help the S&P 500 consolidate earlier gains. The index rapidly came under selling pressure yesterday as the session went on. But US and European futures are better bid this morning, and oil is coming down from an early session peak at the time I'm talking here right now on news that Donald Trump told his aides that he wants to end the war even if the Strait of Hormuz remains closed. But just before that, mood was quite ugly because Iranians struck on a Kuwaiti oil carrier near Dubai and oil was actually surging. So the headlines remain too jittery and very much changing and contrasting each other from 1 minute to another to say something to make a forecast for what's going to happen in the next hour. But if you look at the big picture, what's interesting is to note that periods of economic slowdown do not necessarily mean a one-way market meltdown. Typically, the market meltdowns happen into a recession and during the early months of a recession. Then, softer central bank policies, rate cuts, QE help markets recover. But I have a feeling that today's uncertainty in the Middle East and bad news haven't been priced enough to jump to that conclusion. Because Nasdaq 100 just entered the correction territory on Friday, just last Friday, while the S&P 500 is just around 10% down, a little bit less than that, at the doorstep of the correction zone. So we haven't seen a major sell-off here. Rising energy prices are particularly supportive for energy companies, sure, but the rest of the industries are actually facing higher operating costs due to higher energy prices and squeezed profits. But that's not yet priced in because a FactSet chart actually shows that the forward EPS is still rising on AI-driven upgrades, expectation of resilient margins, and energy sector strength, suggesting that investors are still pricing today's earnings momentum while pushing the potential profit squeeze from higher energy costs further down the road. So the risk is that markets are still buying the earnings story today and choosing to worry about the oil shock tomorrow. But oil prices keep surging. WTI trade near the $104 per barrel mark this morning, while Brent crude flirted with the $110 per barrel level early in today's session. US gasoline prices have rebounded to $3.38 per gallon. That's the highest level since the Iran war started. And Donald Trump may have told his aides that he wants to end the war in Iran, whatever, but he also threatened to destroy Iran's energy infrastructure just a few hours before that, and Houthis are now threatening the alternative trade routes that help exporting oil from the Gulf countries like Saudi Arabia due to disruptions in the Strait of Hormuz. So I would just wait before popping the champagne. Now, in the FX markets, higher oil prices back further strength in the US dollar. The majors were under pressure again in yesterday's trading session, and that despite softish comments from the Fed President Jerome Powell, confirming that the divergence between the US Federal Reserve and relatively more hawkish central bank outlooks here in Europe, for example, do not necessarily determine the short-term direction in FX prices. The euro dollar, for example, slipped below the 115 level yesterday, and that despite strong rebound in German CPI numbers and Jerome Powell's balanced comments regarding the longer-run US inflation expectations that remain in check. Now, moving forward, softer oil prices could eventually reverse the tide against the US dollar and give strength to the majors, but as long as oil prices remain under positive pressure, the US dollar will likely benefit from it. Elsewhere, gold rebounds on falling global yields after having tested an important technical support last week, which is the 38.2% Fibonacci retracement on 2023 to January 2026 peak that should, in theory, distinguish between the actual positive trend and a medium-term bearish consolidation. But the million-dollar question is, could gold regain its safe haven status and its inflation hedge appeal if the meltdown in global equity markets accelerate? Well, the answer is it will likely depend on a mix of factors that include oil prices, the US dollar, and global bond yields. Right now, we see the selling pressure on gold easing gently, but the danger of further sell-off is not yet over. So, the markets will continue to be driven by headlines, by oil prices, and unless we see material progress toward peace, any price rebound in equities, in bonds, or in gold will likely remain fragile. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.